So this leads me on to the last bit. How can I make money from this? What is up everybody, Gifford here and welcome back to another stock market video, and today we're going to be talking about A2 Milk and why they have been hammered down so much. I want to look into this company right now while the price is so down and see if I can make some money from it. I'd appreciate a like on the video, and if you're interested in investing, feel free to subscribe. With that said, let's just get on with it. Straight into the chart, and it's Friday here in New Zealand, and the end of the trading day, it's finished at $5.88. However, if we go back to the 1 year chart, we can see that it's been on a massive decline and getting absolutely hammered. So if we just pull a figure here at $21.50 and go all the way down, it shows it's currently down by 72% from its all-time highs. So over at Simply Wall Street, just a quick summary, A2 Milk is a milk company here in New Zealand, and we can see that the current market cap right now at their price is $4.2 billion. So Simply Wall Street tells us that they have a fair value of $18.10 currently, with the current price at $5.88, and they reckon that it's undervalued by 67.5%. So over in this article, it pretty much tells us exactly why A2 Milk has been on a decline since the middle of last year. So reading from the article, what's really affected them has been the declining sales in China. And these sales are processed through the so-called Daigou channel. Daigou is the unofficial trade network in which baby formula is shipped from Australia and New Zealand to customers in China. So their sales and revenues have been heavily affected due to the pandemic. So what I've got in front of me now is I went to their website and had a look at their half-yearly results to see what other issues that they've identified. So this report is 32 pages, and I'll put a link down if you want to read it, but I'm going to go over a summary right now of the most important points that I've found. So the first slide I got here is on page 5, and the title reads, "Fundamentals remain strong despite significant COVID-19 disruptions." And this first point is very important and reads, total revenue of $677 million, down 16%, and EBITDA of $178 million, down by 32%. So just going back to the stock chart, we can see that they are currently down by about 50%, and the main reason for this is because of the downgrades that the stock is getting. And the downgrades are being affected because the fact that they're not getting as much revenue in. Now the fact that the stock is down by about 0.5% I think is pretty hard, because they're only down in revenue by 30%, but what's happening is that the investors are thinking this is just going to continue and they're actually selling out of the stock. However, in the last 5 days we can see that it's starting to actually bottom off right here. Whether or not it goes up or down from here, not sure. So now the second slide, I've just gone over a summary how they're going to address the second half of the year. So the important point of the slide is right here: reactivate Australian Daigou resellers and retailers, rebalancing inventory levels and improving traceability through the channel, providing temporary support to the Daigou resellers, working with corporate Daigou to drive distribution innovation. So they're putting a lot of effort to try to get back those revenues. So the third slide is their full 2021 outlook, and this reads here, globally there continues to be unprecedented levels of uncertainty and volatility due to COVID-19. And the company is giving guidance here that group revenue for FY20 is going to be in order of about $1.4 billion. However, if we read the last point here on the report, it says that the outlook for FY21 assumes the actions being taken to reactivate the Daigou resellers channel delivers a significant improvement in quarter-on-quarter growth from Q3 2021 to Q4 2021. So this tells me that the $1.4 billion is only in the assumption that they actually can get this going. Now, not even looking at the sales figures, I can see from the chart that it's constantly downtrending, which means they haven't actually been able to fix this in the last 6 months. So they're assuming that if they do, they'll get $1.4 billion. But that's only if this works. What I think is going to happen, and just my opinion, you can think up your own opinion, is that they're going to find this very difficult. And my assumption is that they're probably going to be closer to $1.2 billion, because it's going to be hard for them to actually do something about this if they haven't really done much or gained much headway in the last 6 months. So this leads me on to the last bit. How can I make money from this? And I'm not really sure. So fundamentally the company is still sound. They're not in any danger. Last time I had a quick look is that they weren't really in any debt. They still make a lot of money. Even their PE ratio is pretty healthy at 13.5. Off the top of my head, I think the NZX top 50 companies, the average PE ratios are about 27. So a healthy PE ratio is around about 10 for value investors, and the company does make money, and it's here sitting now at 13. So it's a really good buy if you think that the company is going to be able to recover within this year, but there's a lot of expectation that the company is going to find it very hard to actually recover this year, and that's why the stock goes down. For me, me at this moment, I'm not going to be investing in them. At $5.88, it is very tempting, but I think that they're still going to go down. There's a lot of confidence lost in the company. If it says halves its price to like $2, $3, then I will be thinking about it, because this PE ratio is going to get very attractive. And as you know, the stock price goes down. What goes down eventually has to go up if it's a strong company, because they're not going to go bankrupt. They've got a lot of money. So as it continues to go down, it's going to be more attractive, and invest in us will drive the investors to come back again, because it's just going to be a really attractive opportunity to buy this low. And just remember, while people go, management isn't very good, this is still a big company with a lot of good people still there trying to figure out how to fix these problems. And for me, I've invested into this company before. I did lose a little bit of money, and I sold out of them as they were actually downtrending, because it wasn't one of the stocks I was following, and I just got rid of it. So I didn't lose much out of it. It wasn't really a big deal. It was just in my Sharesies account. But the main reason that I don't like investing in it is I don't like learning about milk products. It doesn't really interest me. And one of the things when you're investing, you should really invest in stocks that you find interest in, you like reading about, you like understanding, because that way, if anything happens, then you'll enjoy trying to find out the information, reading about it, and you'll be all over it. Not some business you don't understand, you don't like reading into, because eventually, as time goes on, and you still have a lot of money in the stock, you're not going to be wanting to read the news. It's not going to be fun. And in the end, if you lose touch with what's happening with the company, with the news, you're going to end up losing money. So that's it for this video, my current thoughts on A2 Milk. Let me know what you think about it. If you're investing, if you think this is an attractive opportunity right now at $5.88 and a PE ratio of 13. Don't forget to subscribe, and I'm also on Instagram, so if you want to follow me there, feel free, as I do more frequent posts on there. With that said, thank you for watching, and I'll see you on the next video. Goodbye.